but one of my objectives is to sort of, and maybe not an objective, but I just thought it was kind of a funny satire of video chats to do this series. And so I'm actually really impressed with your Zoom. They're the first guest that I've had that's actually using a Zoom background. It was funny because I was on a conference call with the Avina guys, and they were talking to a big developer in the city, and they were all worried because their hair was like messy and whatever. They hadn't had haircuts. And then we get on the Zoom chat, they both just called in because they didn't want their video to be on. And we get on the Zoom chat, and all three of these huge developers have the Zoom background. So I thought it was pretty funny. So I like it. It plays into the satire element. Beyond that, obviously my objective for this podcast is just to really just aggregate as much information about what the hell COVID is doing to our real estate market as possible, and be able to present that to anyone who's interested. It helps us in that goal that fluffy kind of we're all in this together concept, which actually seems to be generally what most people perceive about how we're going to surmount a lot of the challenges that COVID's presenting. So that was kind of a convoluted way of presenting the objective of it. But if you could just give me a quick intro of yourself, let me know sort of what you're doing in the real estate space, and then and some career background for those who don't know you.
Sure. So obviously, my name's Ryan Malefant. I'm associate at a boutique private equity firm in Oakville. And basically what I do in real estate is my firm focuses on finding partners that it can invest with and bring projects to fruition. So prior to that, I worked in management consulting, helping executives and teams make sense of their data and identify opportunities and risks. Some of that was in the insurance sector, which is kind of interesting right now. A space that you look for these unprecedented events and you model them, and you price that risk. Especially right now with COVID, I can tell you no models would have predicted that.
That's an interesting one for sure.
Yeah.
So is that like more on the actuarial side?
Yeah, we weren't an actuarial. I'm not an actuary or anything. My background, but we were crunching their client data, so premiums and what they were charging for certain risks and what they covered to help as inputs for their actuarial processes.
Cool. Very cool.
Yeah. Other than that, educational background is business with real estate focus. That's how you and I got connected up. Probably, I don't know, I've probably known you for over 5+ years at this point or more. Yeah.
Yeah, I think I've been out of Guelph for 7 years now.
Wow. So I guess more.
Yeah.
Longer than that. Maybe, could it be maybe a decade?
Yeah, perhaps.
Yeah. That's funny.
Yeah, I know, it makes you feel old. I got a kid now, so I feel old all the time.
Yeah.
Okay. On, I guess, expanding on that, sort of, if you could run me through sort of, what a typical day looks like in your position, and how that's changed so much. Like obviously the video chat and Zoom commute is one element, but beyond that, what does the workload look like? Are you putting out fires or rather than originating or whatever it is? Are you re-underwriting deals to account for this? Anyway, I won't be too leading with the question, but how have things changed since before COVID?
Yeah, interesting question. I'd say that we're pretty nimble small business, so a lot of what we've been focused on since our founding over 2 years ago has been building technology to support the platform, the investment kind of engine of what we do. But really, COVID has forced us to accelerate some of that. So some processes that we might have done in person, we now do online. So that might be like taking a meeting, obviously over video now instead of in person. It's a little different. But overall, I'm mostly I worked remotely quite a bit prior to COVID, so my personal schedule hasn't changed too much as a result of that. In terms of the business itself, it's been an interesting. We're positioned in the multifamily space in real estate, which hasn't been as heavily hit as, say, the commercial
Right.
retail side or um, like some of the office uh, segments of the real estate industry. So it's proven to be um, a solid asset class for us. So I wouldn't say a lot has changed, but what's changed is how we're communicating with our partners and how they're communicating with tenants. I think the dialogues are much more open, um, and the recognition that the situations are rapidly evolving every day. Something is
For sure.
changing. So just because we said we would do something one way yesterday doesn't mean that's still
Right.
the relevant operating scenario. You asked the question about rejigging underwriting assumptions or financial models. We're not at the point yet where we can fully understand the impact of this. What we do know is there's still good demand for quality rental housing. No sort of bottom has fallen on anything. So um, people always need a place to live. People always need a place to shop and go to work as well. So
Yeah.
hard to say how it all plays out, but
Yeah.
um,
And maybe we could use that to pivot a little bit to the macro piece of it. But
sure.
um,
Yeah, I realize I went a bit on a tangent there.
no, it's all good, man. That's what this is all about. I wanted to interject because I'm curious as to whether or not your perspective is on that is if, if multifamily is less impacted, obviously because you can't really shut down somebody's shelter,
Hmm.
or if it's the policy environment really doing an effective job, is it, and we can use this obviously to segue into bigger macro things, but is it because curb is such a direct to the bottom line distribution of that helicopter money to the residential tenant, and that protects the multifamily, or whereas retail with the 75%, it was a month later, a lot of these businesses don't have any income, there's speculation
Hmm.
that they're going to have to pay a lot of it back, etc. I mean, I guess my question is it the asset class's strength, or is it policy being more finely tailored towards protecting that asset class rather than the other?
Yeah, interesting question. I think it's nuanced. First and foremost, people needed to stay home because of the health effects of the pandemic, needing to social distance. So um, the policies needed to keep people in place as much as possible.
Right.
Um, Shutting down the landlord and tenant board was a necessary thing in order to help facilitate some of that. Unfortunately and fortunately, right, for on a macro scale, it's definitely a positive for public health, but on an individual level, it's been tough for some people.
Yeah.
um,
I'm actually a perfect example of that. Sorry to interrupt you, but
yeah,
because
go ahead.
I had a tenant who hadn't paid in a while. We had an eviction scheduled for the first Friday of April.
Wow.
Obviously, the courts were shut down. So and then so it would have been almost a year by the time they hadn't paid. It would have actually been, because who knows when we would still be able to get that eviction. But
Hmm.
when curb came into effect, they decided to start paying their rent again at 150%, until they're caught up. So, which I
Oh,
thought was
interesting.
really, so that's a pretty good reflection of the double whammy, right? Which I thought was, and who knows how long that's going to last with their payment schedule, but I mean, it happened. So I thought that was interesting.
Yeah, and definitely that intervention from the government to keep money flowing in the economy, especially for people who are uh, renting. I think the economic situation in most cases is you might have a few weeks of savings, but not a few months, and that's what that's how everything was starting to play out from very early on. It was, this isn't going to be a 2-week disruption. This is going to be a 2-month plus type disruption. And we're kind of at that about 2-month mark. And it's good that the money is still flowing. The impact for, unfortunately, the retail and the office side is, office, people are going to rethink how they plan their space needs, the willingness of people to congregate in one place. But I think, unfortunately for retail, these are businesses that need to operate in a physical environment, such as restaurants, cafes, uh, any sort of service industry, barbershops, salons. Their livelihood is deeply impacted. And it's good, at least, that the government can step in and recognize that a lot of people's livelihoods have been impacted, but we don't want you to lose your home.
Yeah, for sure. Yeah, I mean, it's also interesting, like even with the mortgage deferrals and everything, I think housing is really, it has evolved very much as Canada's darling. It's a big part of our GDP, obviously, in the construction piece and everything,
Yeah.
directly and indirectly. And so, I mean, I guess that's the naturally obvious target for them to approach first, beyond just it being, the socially sensible thing to do.
Mm-hmm.
Do you think that things are going to change more than they have now, or and this question was interesting at the beginning, when there was a lot more forecasting involved, but
Sure.
do you think that we're going to see more change, or that we're more likely to see things go back to normal? Like what's your kind of outlook on the short term, long term pains that could result as as a result of COVID?
Interesting. Short and long-term pains. Short term, I think, with schools being closed and daycares being closed, at least that's the current stance in Ontario as we speak. It's difficult for parents, and I'm sure you're experiencing some of that. The productivity might not be as high, but also the focus, and the stress is higher. So in the short term, uh, there's a personal impact, and the kind of economic impact of that is still hard to see. Um, I think we're still there. I think there's going to be a bit of pent up demand for certain goods and products
Right.
once things do return to normal. But I think for me, it's when schools reopen or when summer camps open, if they do this summer, that the world will look a little more normal
Yeah.
for uh, call it the 70% of the adult population, right?
Yeah. Yeah, I would agree with that. I think it's interesting that you use the term pent up demand, because I think that there's like, you're seeing a big division between the Bears and the Bulls. Like, I mean, you used to, but right now it's like, the Bears are having a heyday because they're like, oh yeah, we saw this coming, and it's like, no, you didn't. You didn't see COVID
No
coming.
one saw this coming.
You thought you wanted real estate to go down because it would make it more affordable for you, or because you're sadistic.
Right.
Um, but I guess the Bulls now are saying, pent up demand is going to cause a huge acceleration in price after. I mean, TD just released a report saying like prices are going to be up by 7% by the end of the year. Although CMHC kind of countered it with, no, we're in for, pains until the end of 2021, I think.
Right. Yeah.
Um, anyway, I just thought it was funny because I guess my curiosity is, do you think housing or real estate consumption is going to be one of those categories that would experience pent up demand?
Definitely. Just anecdotally speaking, I had a friend of mine who sold a condo in Ottawa, and he was fortunate enough to use that money to turn it into a townhouse on the Danforth in Toronto. So obviously a change of city, but also a change of kind of, he moved up in the housing market, and that's all very interesting because he was someone who was moving, so he had to sell, and then he had to buy. So the only people on the market right now, in my experience, are the ones who need to be. So I think there's a lot less like speculation going on, people just kind of getting caught in uh, the frenzy of, oh, I want to buy that condo. I think it's more people that are saying, for rental purposes, I think it's people saying, I need a shelter, I need a place to live, and
Yeah.
I need to do a deal, and I need to find one that makes sense. And it's still a competitive market. uh, this was a deal that got done last week, and he's describing still multiple offers on on the properties he was looking at. Um, and so now, I've been tracking some of the data you've been putting out, Daniel, about volume and
Yeah.
where prices might be going. I think with low volume, you're going to see people holding back on purchases because they might not like what's out there. So,
Right.
and they're not sure about what their work situation is, because a lot of people buy based on where they work. So, how that plays out, I think we're going to see a bit of a May, typical May market, which is a hot time of year, but it'll be lagged for 3 months, 4 months. So we might see September, October, November as being a really hot market. I don't know, but
Yeah.
those are my thoughts.
Yeah, it's interesting. I have a hard time wrapping my head around the qualitative element, and obviously I do a lot of analysis in the resale market just for my family business. And I have an opposite thesis as to what you're describing, which I think is interesting, in such that I think that a lot of the supply, is going to be like, I think a lot of the bears are thinking, okay, there's going to be pent up supply. And
Oh,
I'm
interesting.
yeah, but the supply is still hitting the market. Like we had as many listings in April as we did in February. I mean, February is obviously February, but still,
Yeah,
I, but the sales are down like 60% or something. So it's not getting absorbed. And so I guess my curiosity, and again, I don't think we really need to get into the nuanced discussion of this, but if you want
hmm,
to, I'm more than happy to. It is if buyers, like I guess, if buyers were happy purchasing in February in multiple offer scenario, or early March when the market was kind of finding its spring equilibrium, um, when there was relative supply scarcity and excess demand, they would probably have a very easy time finding a property on the market today, because there's so many more, right? Like there's relatively more supply.
right.
And so I guess my question is, what other reasons would they have to not be purchasing today? And my hypothesis was that, they're anticipating that prices might decline, or they want to at least wait and see and sell. And the fact that we're still seeing sustained listing volume tells me that sellers have sort of the same philosophy, that maybe they're trying to get in because to avoid the cost of losing that equity if the market does decline. And so my thesis was that both
Interesting.
buyers and sellers are behaving in such a fashion that they think prices are going to decline, which I thought
Interesting.
was, so that's just the devil's advocate version of it there.
Yeah, and another component of that is people might be delaying purchases and choosing to rent for the next year and see
Right.
how things play out. Maybe,
Yeah.
to kind of build on your hypothesis, is that, if they do anticipate prices to go down, then they wait it out and maybe try and find a bit of a trough. But
For sure.
um, it's hard to say. I think especially when mortgage rates are so cheap, the cost of $100,000 on a mortgage is only a few $100s a month.
Yeah.
So how much are you really saving versus the intangible benefits of getting what you want, enjoying that home, having that safe, um, that tenureship of home ownership,
Mm-hmm.
whereas in rental it's different. Um, I think what we're seeing on the business side of things in our multifamily holdings is people are deciding to stay in place. So we're not getting the same volume of uh, notifications to vacate. And typically in the spring, that's when people would start looking at the next rental property, or maybe they jump into home ownership. But we're not seeing that volume, as kind of things are a little uneasy, and difficult to the situation just changes so rapidly. It's hard for someone to want to commit to moving out on a particular date if they don't have something else yet lined up.
For sure.
And so everyone is kind of, and because of that, there's less volume on the rental side of things. So and that definitely plays into the home ownership side. Like there is a barrier there where the two kind of intersect.
I would say, yeah, for sure. And I think, like, again, a lot of the metrics that you would use to substantiate making a single family investment, let's say, you know, low vacancy and climbing rental rates, there's speculation that those would decline. And I think that that's a fair assumption. You know, those could present challenges for values to stay propped up by fundamentals, which apparently Toronto's completely detached from anyway.
Yeah. Well, on the condo rental side, for sure.
Yeah. Negative cap rates all day long. I think condos are going to suffer. I think, actually, I don't know. I'm still trying to figure out what it's going to look like in the single family detached space, but condos, like, anecdotally, I mean, on the data side, it already looks like it, because you're seeing some supply flood with ghost hotels and negative cap rate stuff. Like, I think a lot of people are trying to are having that internal dialogue of, do I want to lose money fast, or do I want to lose money slow, right?
Yeah.
And I don't know. The question is what the domino effect of that, in when your pre-construction market is 30% over fair market value, even a no growth environment, which would be healthy, to be honest, it's fine. Or even growth at inflation, at 1%, 2% is fine. But it's not if you need your property to be worth $1,400 a foot by the end of 2021 when it's supposed to close. Or, I mean, that's hyperbolic, I would say, but let's say 5 years out, 4 years out. So I don't know, man. That's the scary piece to me.
Yeah, that's an interesting segment, pre-construction, for sure, especially because the values are sold at future prices.
Yeah.
And the need to get financing when those projects are finished is real. So it's a pre-construction's always been a bit of a kind of hope and pray strategy, I think, for a lot of people, but it's played out well because there's been so much appreciation in the general market over the last, I would say, 20 years. Really, it's been this raging bull.
I guess 2017 would be, in a couple of micro environments, would be the one example where that went awry. I mean, I'm actually sitting in a very prime example of that right now. I refinanced a couple of my assets last year and decided to rent for a year while we built a house. Started my lease in January. I'm living in a house that is well beyond my means in a subdivision in a great location, and it's because this development pre-sold in 2017, right before the crash, and it closed. By the time they closed, which was just recently, the house is brand new. They were down 20-30% across the board, and there's still phase 2 and 3 for sale at the sales office. I can walk. I'm in a house right now where the guy paid like 1.3 million, and I can walk 100 meters and go buy the same house for 950 grand.
Wow.
And then you also see all the guys who bought these, who are trying to flip them out, have them all for sale and for rent in the neighborhood, right? So there's 40 or 50 of these, and I just literally went and started bidding on all of them, purchase and lease. And I just said, what's going to make the most sense here? And so I'm just wondering, I guess, if there's potential for that to happen. I'm wondering if there's so much volume, demand side and supply side, like, because there's more condos and it's more concentrated into an area that a lot of people want to live, being Toronto, that you might not have that sort of fringe market, like the micro market phenomena that could really cause it to decline. But I don't know. It keeps me up at night, honestly, because I think I just don't want things to end up like I mean, I don't want them to look like 2008 in the US, but I also don't want them to look like 1990, or I guess 1990.
Early 90s,
Like, I think that, I mean, it's just, I don't know. It could be bad, right? And I think that I guess my question before we move on to the next actually structured question would be, do you think that the looming macro factors are like employment? Are we going to see a full recovery of employment? Probably not. Credit crunching, like historically high household credit. Like, do you see these things playing a role in whether or not things could get worse? Or do you think that we're like the government's just going to kind of, because we do have it, it's accessible for them to really do something about it because our banking system is so oligopolistic. I think it's
Yeah.
a lot more accessible than trying to work through 2,000 institutions in the US. But I'm just curious as to your perspective on that.
Yeah, I think the fundamentals are still strong, honestly. Um, from a real estate perspective, the migration is tremendous in the GTA. It's definitely an economic growth engine for this whole country,
Mm-hmm.
especially when oil is not in the foreseeable future. Exploration and development of the oil patch in Alberta is not going to happen, which is another economic driver for this country. Um, you might see some of those people relocate to bigger centers like Toronto that have a bit more diversity in the economy. Um, but I think there's also some local economic policies that will kind of provide a bit of support for especially condo prices. I think they're the most commoditized product when it comes to real estate, because you can compare a two-bedroom to a two-bedroom across the hall, and it's apples to apples. So if prices did start to decline, it would be very easy for them to decline all in tandem, and that might happen very quickly. I don't see that process happening slowly, but there will be a floor because, quite frankly, it's very expensive to build in the GTA. Development charges are high, and there's still a profit that needs to be made on development. So for certain product categories, I think there's a certain intrinsic floor to how low prices can go. If that makes sense.
No, it makes a ton of sense, and I actually I didn't think about it so much in the identical floor plate being over 50 stories, and how that comparison could actually, like you said, it could speed up, it could expedite that kind of drop. So that's actually a really good insight. I guess my curiosity would be in what you just described, because I agree with almost all of it. I mean, obviously DCs aren't going away; the government's still going to get theirs. Um, do you, and then the only malleability, I mean, we could, I guess, see some changes in the dynamics of labor supply and demand that
Mm-hmm.
might make things a little bit cheaper. But at a certain point, I guess, how does what you just described, hitting that floor, how would you mechanize that? And it could be in many ways, but is it hitting equilibrium where enough developers say, you know what, it's not profitable for me to build at this. They cancel the project, they put it on hold or whatever, or is it, we pivot, it doesn't make sense to sell this project anymore, so I'm going to pivot to, if I'm going to take a loss on the project, I'm just going to pivot and go to purpose built rental, and I'll lose, but I'll get to hold the asset, as an example, right? And they go get a CMHC loan for purpose built? Or is it opportunism scoops in? Like, does it end up being a qualitative thing? I guess, which of those scenarios would you say is most likely to be the thing that props it up, or is it all of them combined? And am I missing something?
Interesting. Always interesting. um, I think it depends, right? I think there'll be a lot of opportunism come out of this. I've seen large pension funds go out and develop uh, condo blocks, like just to get a yield.
Right.
And they're doing that out of necessity, because as interest rates go down, their pension liabilities go up. So what that all means is they need to continue to find uh, projects that are higher return, but also higher, like, cash flowing projects.
Yeah.
And purpose built rental definitely fits the bill. So it might be uh, apartment developers choosing to pivot into merchant developers, where they build a building, rent it out, and then flip it to a pension fund, for instance.
Yeah.
So I think there'll always be activity, whether it's rental development or condo development. I don't think it stops even if values do decline, because there's always that value in a rental complex as kind of a bond, if you will. Like, it throws
Yeah.
off a coupon, and there's always a certain floor to that.
Yeah.
And that could be an interesting market dynamic if, say, the condo environment evaporated, but then all of a sudden there's the developers supported by large pools of capital that want to own high quality rentals. That will provide support for the market.
For sure.
I think people will always be looking for opportunity, even amongst the chaos here.
For sure. For sure.
Yeah, I don't know that I'm doing a great job at answering your questions.
No, you are, man. You've given a lot of insight. I think people underestimate the cash on the sidelines right now, right? And I think you're right. Like, I've seen opportunism already, on the purchase side.
Yeah, definitely.
I guess on that note, and then we'll maybe wrap up. So I'll probably group those last two advisory questions together. But is there any advice that you find yourself giving to clients, colleagues, friends, whatever, on how to deal with this, like in a professional capacity or even in a personal capacity? How do you find yourself advising people to deal with the COVID?
Yeah. The number one piece of advice, I think, would be to be open,
Right.
communicate, see things from different people's perspectives. If you're dealing with a tough situation, tell people, they understand, work with them, try and find solutions. And that applies on the professional side as well. If you're working with partners and they're having difficulties closing on a deal, or they're having issues dealing with their tenants, or you're having issues with your tenants, always having that open line of communication, as opposed to being standoffish and trying to put a line in the sand, because honestly, the tide's coming in every day and wiping out that line. So why try and turn that relationship into an adversarial one when there's actually a good opportunity to find some mutual ground and see things from other people's perspectives, and tell people where you're at too, because just because they have one point of view, you have a different one. Just try and show them why you have that point of view.
Right.
Basically be diplomatic. I guess that's the key advice here.
Yeah. It's really very well said, and an awesome summary of most of the advice that I've heard on here. So it's good to see, I mean, a lot of people don't even watch the other videos that they've been on. I try and convince them to, but they don't. No, I'm just joking. I would say that there's decent viewership, but it's interesting, people who haven't had a chance to listen to the past videos, and they often just end up saying the same thing, that the necessity for collaboration is just such an interesting theme to have arisen here. It's like really the first time in human history. I mean, actually, that's definitely not a good example, but it's the first time in our lifetimes, I would say, that, or at least our adult lifetimes, where we're conscious economically, where nature has revealed to us this desperate need to work together on something. And it's just so interesting to me to see. It gives me a little bit of faith in humanity to see that we're actually doing that. Maybe it's a selection bias because I talk to nice people, but I don't know. It's cool. Anyway, before we sign off, is there anything you want to add that we didn't get a chance to discuss that you think is important to inject here? Or
let me think about that for a second here. I think just stay positive, look for opportunity in all this. It's difficult. It's like, try and learn out of this. I've been connecting with as many people as I can on my side to figure out, again, going back to learning and communicating and talking with other people. And this will be this will be a time that we reflect back on, and how we manage ourselves both professionally and personally is our true character, right? So we stick to your true values, and like continuing to sorry, I lost my train of thought here, but
All good, man. All good.
basically like staying the course, like
Right.
this is an opportunity to learn, and
Yeah.
learn for yourself and learn from
Yeah.
others,
Yeah.
because like I don't think we'll encounter another big challenge like this.
Yeah. Well,
Hopefully
fingers crossed. I
hope
certainly hope not.
yeah,
Yeah.
so figuring out how to make our businesses resilient to this sort of thing, planning for a worst case scenario similar to this,
Hmm.
having this in mind that economic uh, prosperity isn't a given. It
Yeah.
does ebb and flow.
Yeah.
Being ready for a situation like this.
Yeah. Yeah. And I think that, you summarized it quite well before as well, even despite losing your train of thought, that I think it really will test the resilience of your character as well. Right. And that it is important to stick to your guns and
Hmm.
remember what you value through something like this. So it's really, really sound advice. I really appreciate, you've brought a lot of, I find that, I often get, certain little tidbits that I really hang on to, but there's a couple of things you said there that created a lot of clarity for me. So I appreciate that. I appreciate your time, and I think I guess the final question that I ask is just if anybody wants to reach out to you to pick your brain, or if they want to do some private equity, or just have you underwrite a deal or whatever. How can they do that? What's the best way for them? Do you prefer LinkedIn or email?
Yeah, best way to reach out to me is on LinkedIn. I'm very active on there in terms of checking it.
Awesome.
And Messenger, that's typically how Daniel, you and I communicate, so
Yeah.
that's good. So it's just Ryan Malefant and 27s Capital. So
Awesome. Yeah, I'll post a link in the show notes as well, so people can just tap it on their phones. And I get a lot more consumption on the podcast than YouTube. I guess people don't like looking at our faces, but maybe
interesting.
maybe your fancy background will change that for me. Yeah. Anyway, I again, I really, really appreciate your time and insight. And I think it's going to bring a lot of value to a lot of people. So thank you.